is a great place to start. The first question that came in is from Paul, and he says, I am new to option trading. Where do I begin? Okay, it's a fantastic question. That's the starting point. To begin with, the first thing that you want to know, and you already probably do know, Paul, is that if you've already set up an account and applied to trade options, you probably know if you're confirmed to trade level 1, which pretty much just allows you to do covered calls and maybe buy calls and buy puts. You may have been qualified for level 2, which may allow you to do some more complex strategies, maybe selling cash secured naked puts, or you may be able to do even vertical spreads perhaps. Each brokerage account, each brokerage house I should say, has sort of different levels of what they call level 1, 2, and 3. So the first thing to establish would be what is your level, which dictates what strategies you're going to be allowed to trade. Okay? Now, once you know what strategies you're allowed to trade, you want to make sure that you get educated on that strategy. Don't worry right now about trying to learn, oh, I heard about this great thing called a broken wing butterfly. I want to learn about that. Well, if you're not qualified to trade spreads, that doesn't apply to you right now. You want to spend your time researching and analyzing the positions that you're going to be able to trade and actively trade in your account at this time. So if I was at level 1 trading in my account, my Fidelity account, for example, I know that I'd be allowed to do covered calls, buy calls, and buy puts. That would allow me to do about 5 strategies right now. So let me remove all of these here first. And if I know I'm qualified for level 1 where I could do covered calls, buy calls, and buy puts, and of course buy stock, then I know I can do covered calls. I can do simple long calls. We can do long puts, buying a put, speculating on the market movement. I can do a long collar, which is similar to a covered call, but I may also buy an out-of-the-money put option to protect against the downside better than your standard stop order. And you'll also be allowed to do married put positions where you can buy a stock and buy a put to ensure the position, and then you can make an adjustments on that going forward. So the first key is you'd get educated on the strategies you're allowed to trade, and don't go too deep. And what I mean by that is that if you're concerned about the speculation of buying calls and buying puts, even though they're leverage positions and they require a lower amount of money, but keep in mind the knowledge that you'd have about buying a call. You're risking 100% of what you invest in the position. Now, what do I mean by that? Let's take a look here. We'll just go to a simple stock. Let's just go to Agilent, and let's go to the chain. And we'll just look at the long call chain a couple months out in time. Let's say we go to May, for example. Okay. Now, with level 1 trading, you're allowed to do covered calls, meaning you could buy stock and sell a call against it to generate a little bit of premium. You can do long calls, just buying calls, speculating on the movement of the stock, or buying puts if you have a bearish sentiment. And again, you could do long collars and married puts as well with level 1 trading. Now, what I wanted to impress upon you is that if I'm bullish, let's say on Agilent, and I'm interested in buying a call option, this maybe I'm only trading with $10,000 right now, and I don't want to put up $3,700 or maybe $7,400 to buy 200 shares of stock and take up most of my account. So I'm thinking about using leverage to speculate on a trade. And I'm thinking that Agilent may have the potential to move up to $39 or $40 over the next month, maybe 60 days or so, and we're 91 days out here with May expiration. And this is just a little bit on long calls here, so we want to make sure we have enough time to match our expectations. So let's say that maybe I'm interested in buying a call, and I can see the prices here on the ask price for the different calls. Now, it would look good, let's say of our $10,000 we had to invest, I only wanted to put maybe a 10th or 15% into this account, or into this one trade, so I know that I'm investing $1,000 or $1,500. Well, if I look at the 40 strike that's trading at about $1.25, well, that dictates I could do as many as 10 contracts and we have an investment of about $1,250. Whereas if I wanted to be a little safer and go in the money, I'm going to pay a higher price, almost $6, which dictates I may only be able to buy 3 contracts, really 2 contracts, and put in $1,200. But in either case, whether you did 10 contracts of the out-of-the-money 40 strike or 2 contracts of the in-the-money 32.50, you are at risk of 100% of what you invest into that position. Okay? And that would allow you, that's just being aware that no matter how much you put into the trade, you're risking 100% of it. Well, I bring that up because married put positions and long collar positions, you can control your risk a little bit better. You have to put up the money to buy the stock, but you have a guaranteed floor, which you don't have with a stop order, because the stop order can get violated and so forth. But long story short, some of the ideas here are how much you're willing to invest. That's the first thing. How much you're willing to risk in each position and proper position sizing. So education is key when you're just getting started. Calvin commented in that he sells naked puts in his Fidelity 401k. All right. Well, that's fantastic. Okay. And some 401ks will allow that. I just recently applied, believe it or not, 2 years ago in my sort of restricted IRA account at Fidelity to trade naked puts. I've had that account for almost 10 years, and I just applied to be able to sell naked puts there as well. I mean, that's one of the strategies. Oh, I didn't put it up there. I'm sorry. Yeah, if you're allowed to do cash-secured naked puts with level 1 trading is what we were talking about in regards to Paul, you could add that there as well. So it all depends on what you're qualified to trade. Now, in addition to that, if we go back to square one, Paul, and if you do have level 2 or level 3 trading, and you can trade up to maybe 15 or 20 strategies, well, you want to focus on the ones that appeal to you best. Okay, and there are certain strategies such as credit spreads which may apply to you if you have a smaller trading account. And I don't know, Paul might have a huge account. We're just going on the basis here. But if I have a smaller account and the margin requirement, the difference in the strike prices of a bear call or bull put credit spread applies to me, remember the leverage spread trades, you're typically looking for a position that has a high probability and is out of the money, so you have a better probability of earning that return. Well, those ones with a higher probability would typically come with a 10-to-1 or 9-to-1 risk-reward ratio. And what that means is that if one stock suddenly goes against you and hit the full loss in the spread, you could have wiped out 10 previous trades. That's a danger with the leveraged position. That's also why I brought up the fact that when you're trading long calls, there are some places out there, some websites that advocate, oh, we can make 400% returns with buying long calls. We can make 350% returns per week buying calls. Yeah, that's possible. But every long call position you're entering, you are risking 100% of that. If the stock stagnates or falls, and you're buying just at or out of the money calls, you could lose that whole premium or see it go down to 5 cents very quickly. So can you make 400% on a long call or long put trade? Absolutely. Are you going to do that 100% of the time? Absolutely not. And if I put in $2 into one position and I make 100% return, I sell it for $4, so I make $200 on the $200 I invested, that's great. But if in the other long call I put in $300 and bought one contract at 3 and it falls, the stock falls 20%, 15% in a short time frame, my option's probably going to lose close to 80 or 90% if I'm not careful. So, I sell that and I've lost $295 on that one call. So it's great that I made 100% on my first call, but I lost more than that on the other call. So it's sort of a trade-off there that you have to pay attention to. Okay. Now, studying the risk reward of the available strategies, when we do a covered call, if I buy stock and I sell a call, it's considered to be, by most brokerage houses, the most common, which it probably is, and the safest option strategy. It's absolutely not. And this is the most popular, but it doesn't mean it's the most conservative. If I buy a stock, and we'll take Agilent again, if I buy a stock, say 100 shares of Agilent at $37.44, I've paid out $3,744. If I sell the March $37.50 call, and let's say we collect 80 cents, now sure, I've dropped my cost basis down to about $36.64, excuse me. Okay, so we do have downside protection. The stock could fall to $36.64 before we start losing money on the trade, but we're still risking 94, 95% of the same risk we'd have with the long stock ownership. Okay, so it's not really a conservative strategy, especially in what we've seen in the last month and a half. If you opened a new covered call portfolio on January 4th, or even December 30th, for example, but if you open on January 4th, a lot of your positions are probably down 15 to 20% almost since that time. And if you're generating only 2% premium against it, that means you're down about 18%. Now, a lot of covered call websites and a lot of covered call quote-unquote gurus say that that is the that's not a problem. You don't care about the downside of the position. You just keep rolling down your calls. So if this stock fell, I might buy back my $37.50 for a cheap price and sell the 35 for 70 cents. Then the stock goes down to 32 and then I roll down again. I'm losing more on the stock than I'm going to gain back with the options. And if the stock quickly recovers and now I get assigned at 30 or 32, I'm going to have a significant loss locked in. Okay, so that's part of the problem there with the covered calls, that you're still taking on 90% of the risk. And people say, well, you just use a stop order. Okay, and that's common what you do with a stock portfolio as well. But a stop order only works in normal market conditions, meaning that during the trading day, if your stock's down 1 or 2% one day and falls another 2% the next day and then falls, let's say 4% the next day, and you've hit your trigger point of a 7% stop order, you get closed right around that price, that might be okay. If something happens overnight and the stock gaps down 10, 15, or 20%, the stop order is triggered at your 7% line, but the market maker can't give you that. He can only fill you what the market's offering, so you still lock in a 20 to 20% loss. Now, think about covered calls that we just talked about generating that 2% premium. If I take a 20% loss because a stop order was violated on one position in my portfolio, and I open 10 positions and they all averaged in a covered call portfolio of a 2% gain, even if my other 9 positions get assigned and I make the 2%, we are right 90% of the time, but we're coming out of the month with a loss. All right, because we lost 20% on that one, we gained 2% on the other winners. If all money was equal, which it never is, but if all money was equal, we gained 18% on 9 positions, we lost 20% on 1 position. We're at a loss, even though we're right 90% of the time. With spread trades, that's even more noticeable. All right, most spread trades, if you're looking for a high probability of getting assigned, you may be looking to make 50 cents against a 5-point spread, which is an 11% return, which is fantastic if you look at the numbers. However, the risk is $4.50 on a 5-point spread. So if one position goes against you, you lose $4.50. So you can essentially be right 80 to 90% of the time with credit spreads, but if one goes against you for the full loss, you're coming out of that month or out of that time frame with a loss as well. Okay, so the 3 points of education: get educated on the strategies, educated on the risk and the reward, know what you're risking in each position, assume the worst case scenario in each strategy you're researching, Paul, because that's going to give you an idea of what you are willing to risk. If the worst case scenario happened, how much are you willing to risk in that strategy or in that one position, and is it worth it to you long term? Okay, and to be honest with you, even though a lot of the brokerage, this is something I never understood originally, for a long time, a lot of the option-centric brokers, when you first applied to trade options and you've never traded before, they'd allow you to do level 1 trading, which essentially just allowed you to do covered calls at first. And again, that was touted as the safest strategy because, and it also was appealing, right? I can buy stock, or if I already own stock, I can sell calls against it. I'm renting out my stock. Well, look at just the straight risk reward. You've got a limited risk to the upside, maybe 2 to 3% depending on which strike price you select and how much downside protection that you want, which means you're still risking 98 to 97% of what you would have risked in the stock originally. And long term, if you assume even a 50-50 win-loss ratio, if even you pick winners, the stock moves up 10, 12, or 15%, but you have a capped gain of 2 or 3%, but you're still taking on losses with stop orders of 7 to 8%, you're never going to get ahead. You're going to have to be right close to 70 to 75% of the time if your max loss on your losers is 7% and the max winners is 2 to 3% in order to be profitable long term. One technique that we advocate that I use in 60 to 70% of my account, of course, is the married put technique, the radioactive trading techniques developed by Kurt Frankenberg, where every stock position I open is reverse of the covered call. I have an unlimited upside to begin with, and I can set a guaranteed limited risk to the downside of only 4, 5, or 6% on my position. Okay, so, and then collars, long collars is a combination of the covered call, where I may still be able to make 2 to 3% on the upside on my stock position like I would with a covered call, but I can also set it up so I can minimize my gain even in an overnight pre or aftermarket drop of 20 to 30% where I'm only losing 3 or 4%. Those are the 2 most conservative strategies related to options or married puts and long callers, not the covered call, and not speculating with buying calls or buying puts, which are leverage positions. Okay, that's my opinion. We might have someone that comes in and says that, oh yeah, well, I've heard about broken wing butterflies and ratio call spreads have the same risk reward. Yeah, but they have a very small window of profitability as well. And so there's always a trade-off there when you start getting complex and start combining different options into that scenario. Okay. Question from Jim. Two questions from Jim. Jim says, how can I see the midpoint? Well, if you haven't noticed yet, inside the portfolio, the numbers now showing as you're tracking positions in the portfolio for your price of your option, the current price of the option that is in your portfolio, whether it's a covered call, long call, this is now using the midpoint, the current price and change. And when you go to the position analysis view or analyze the market value, it's based on the midpoint. It's all over the site and other places as well. We were on the chain, I think, when you asked this question, Jim. We don't have the midpoint shown right here on the chain as a selectable column right now, but that's probably going to be added sometime. I can't give you any estimation of that as well. And sometimes you might be able to see it. No, actually, I don't think it's in the call research tool right now. Let's see, last mid, high, low, last trade. No, it's not there. Okay. So yeah, that's not there, Jim. And you said if you have the 20-minute delayed search, will the search show today's opening prices 20 minutes after the market opens? The first data run usually comes through at about 9:50 to 9:55 a.m. So it's usually right around that time. All right. Okay, Scott commented on another question here, or commented, I'm sorry, in our discussion with Paul. He says, you also have the challenge of the emotional side with covered calls. I agree. And it's with any strategy, really, Scott, but I agree with you. I kept chasing INTC only to break even because I thought INTC would decrease, which it didn't until after the earnings report. Yeah, and that's a very common, any strategy, really. And I think you guys have heard me talk about this before. I'm going to go ahead and add in bull put credits for right now. And we already got covered call. Oh, and we had a gentleman mention naked puts, which I thought I had added and I hadn't, which may be available in most places at level 1 trading, but it might not be. All right, now a naked put is essentially a parity trade to the covered call. We're selling a put here which obligates us to buy shares of stock at that strike price. And so if the stock falls, we may have to be forced to buy shares of stock there. It has the same risk reward profile as a covered call position. And to be cash secured, you'd have to put up the cash to cover the obligation of buying the stock. Now in a bull put credit spread, you can sort of cap some of that downside loss, but take away from the premium. All right, what do I mean by that? Let's go ahead and take a look at a search real quick, and I'm just going to pick the first stock that comes up in our naked put. Wynn Resorts, this is bull puts, of course, I'm sorry. Wynn Resorts is trading at 77.18 today. We could sell the March 70 put, $7.18 out of the money for $2, and buy the next strike below, the March 67.5 put for $1.47. Now, my net credit is 53 cents. But if the stock falls below 67.5, I have to cover the 250 between the strikes, and so my maximum risk in that case is going to be around $1.67, I think. No, I'm sorry, I did that math wrong. But let's take a look here at the profit and loss chart. It's easier to see it in that way. Okay, well, sorry folks. We wanted profit and loss chart, not big charts. There we go. All right, sorry, so with the 250 spread, it's a 197 risk, meaning if the stock falls below 67.5 between now and May expiration, I'll be forced to buy shares of stock at 70 for the obligation of the short put, and forced to, I can force someone, to buy shares of stock at 67.50. So I lose the 250, but I keep the 53 cents, so I have a 197 loss. Now this is not as extreme as some of the positions I was mentioning earlier. Okay, so this is about, let's call it a 4-to-1 risk-reward ratio. So if I open 4 positions that had the same risk-reward ratio, where we're making 53 cents and risking $1.93, okay, so if we take in 53 cents on all 4, we'd have about $2.12, of income per contract. Now at expiration, these 3 expire worthless, and this one here goes against us for the full loss, so we lose 197. Okay, so we were right 75% of the time, and we have a small gain, right, of about 15 cents for our 4 trades per contract, $15 if we did one apiece, okay? But we were right 75% of the time, and we make a profit of 15. However, that's going to be taken up, even if we did multiple contracts of each spread, that's going to be taken up by the commission fee that we had to use to enter those positions. Okay, so that's still an illustration of what can happen with a 4-to-1 risk-reward ratio. Okay, but it's attractive, isn't it? I only have to put up $197 to make 53, which is a 26.9% return. That sounds fantastic, and we're 7 points out of the money. What could go wrong? Well, what could go wrong does go wrong in some instances in a portfolio that's staggered towards leveraged strategies. Okay, now I'm getting to the point Scott was bringing up here. What I wanted to show you is, by comparison, if I decided not to buy the 67.5 put, which lowers my margin, and instead we just sold the March 70 put by itself, a cash secured naked put on Wynn Resorts. Well, we'll take in $200 now instead of 53 cents. Well, my broker may require me to put up the full cash amount if I was forced to buy shares of stock at 70. So for one contract, I'd have to put up 7,000 to make 200. There's that 2 to 3% return we were talking about. And if the stock stays above 70, the put expires, we keep the premium. If the stock falls below 70, then we're going to be forced to do it. Now, why am I going through all this? Just like the covered call that we saw before that had a similar risk-reward profile, and even the bull put credit spread, a common adjustment that's taught for free on most options websites, and it's taught for free on most options websites because it's common knowledge, is that, oh, well, if the stock falls against you and hits your put strike price, simply buy to close that put and now sell to open in another one, a 67.5 or a 65. Roll down with the market. Well, you were picking a neutral to bullish position that's now started to move against you. If I simply buy to close this put, which is going to cost me a lot more than $2 to buy back if the stock's trading down at, let's say, $69 per share and I still have 2 weeks left, well, I'm going to negate this and probably add a little bit, and so my next premium I receive is going to lower my max profit. I have a little bit more downside cushion. But the direction is already wrong. I'm still holding a bullish position now on a stock that's falling in price. So if it continues to fall, then I have to adjust again and again. And if it recovers quickly, I may be locked into a loss, especially with a covered call. Okay, so that is a common way to adjust positions, but it's not the only way. There are better ways to adjust positions. Same with the bull put credit spread. Even if we had the floor at 67.5 that we saw earlier with the bull put, if the stock reaches down to 70 or just below 70, it's common thought to just buy to close the short put, sell to close my long put, and then open, let's say, a 67.5, 65 bull put spread, which will have a lower potential return, but now you've got more cushion. But if the stock continues to move against you, you're continuing to lower and lower these strikes for less benefit. And that's what happened to Scott as he was rolling down the INTC covered call. And then eventually, if it bounces back, sure, this may work out, but I may be in a loss, or I may get assigned on the covered call for a loss. You could roll it back up. Sometimes this is better just to take the loss and move on. Or if your sentiment is still that the stock's going to fall, you might want to convert this to a bearish spread, something you could do, or do the opposite. Simply buy to close the cash secured put for the loss, and then maybe buy a put. So if the stock continues down, you can make money on the long put now to counter the loss you made on the original position. There's a ton of other strategies to manage these different positions, and that's one of the things that I wanted to go to. In addition to what we talked about with Paul, with picking what strategies best suit your risk-reward tolerance for your portfolio, Paul, identifying the capital and your trading plan. You always want to set that up too. What are your goals for using options? And make sure they're realistic. And we already talked about how we know that some leverage positions are touted as being able to make 200, 300, 400% returns. Yes, it's possible with leverage calls and puts to do that. You're not going to do it 100% of the time. And if you're talking about making 200% on a call that cost $1, but you open 10 positions and 5 of your other positions went to 100% loss, you're still going to be negative for that month or that time frame. That's the key to the leverage positions. It may sound sexy and it may sound attractive, but you've got to take everything into account. And sorry, in addition to that, it's not just about knowing the strategies themselves, but knowing how to manage the positions and setting your trigger points and setting your exit strategies before you open any position. This is a free page. This is our webinars page, Paul. I don't know if you've ever seen this before, sorry. And I'll just send everyone this link. It's powerop.com/webinars.asp. And if you go to the Option Strategies tab, you'll see several webinars on the different strategies: selection criteria for buying options, management techniques for your long options, introduction to naked puts, managing your naked put positions, the management techniques if that cash secured naked put goes against you, vertical spreads. Those are the credit spreads and the debit spreads that we were talking about, just like the bull put credit spread, managing spread positions, managing bull put credit spread. So the management techniques, knowing what you may have to do before you actually have to do it, is also essential as well. And the Power Options education here will give you great insight into that. In addition to that, the tools here will help you. There's in every main little home page here, there's learning centers for each of the strategies, introduction material, what is the strategy, what are some of the common rules of the given strategy, guidelines I should say, and things of that nature as well. Okay, all right, so yeah, the emotion comes into it, as Scott mentioned. You want to make sure that you know those as well. Jim asked a quick question. I'm just going to review this real quick. We talk about this a lot at the webinars. I don't want to spend a lot of time on it. Jim asks, what are your other favorite strategies besides married puts and long collars? Those are my favorite strategies. There are other strategies I use, Jim, but those are by far my favorite. I started close to about 13, 14 years ago actually trading options when I started working with Power Options. Just like Paul might be in this situation, which is why I started here, what I just went through is how I started to learn options, okay? And I started with covered calls. I wanted to know the ins and outs of covered calls because 14 years ago when I started working with Ernie and I applied to trade options with Options Express, they originally started off with just level 1 trading. I was a young guy. I was in my 20s and I only had about, I think it was $15,000 to trade. So I'm actually very happy they didn't give me any further approval at that time. So long story short, I started with covered calls, and after 18, 19 months of trading covered calls, I did have a winning record where I could say that I had won more positions where I'd gotten assigned or earned a profit than I had lost on. But my total return over those 18 months, factoring in losers and rolling and everything else, was only about 2 to 3% for 19 months. Well, that's not getting it done. I tried adjusting stop orders. I tried different stock techniques, dividend stocks, in the money, out of the money, all different things to get a better performance. And every change I made was a little bit better. But once I factored in the losers, as we talked about, it wasn't doing it. Now, thankfully, about 8 to 10 months into trading covered calls, I did shift to trading collars because I did qualify at that point for the level 2 trading at Options Express. They enhanced it, so I was allowed to do collars and naked puts. So I started to do collar spreads, and my collar portfolio started to vastly outperform the covered call portfolio because the losses were controlled. And then I started doing cash secured naked puts, which I did really well at until I didn't do well at. And again, what does that mean? That means that even going 6 to 7% out of the money with a cash secured naked put, at that time you were looking at a 1 to 1.5% yield going 7% out of the money for a 30-day trade. Weekly options weren't really readily available at that time. However, I could still get a 1 or 2% yield for a weekly option now on several stocks, about 450 of them, but I'm not going 7% out of the money. I'm only going 1 or 2% out of the money to see a weekly yield of 1 to 1.5%. But in any case, it worked well until it didn't. And I could have been successful for about 8 months out of the last year using that same strategy with naked puts, but I would have given all of that back within the last month and a half just because the stock's declining. I might have taken assignment on some stocks and tried to manage it as a covered call or a collar at that point. Might have taken assignment on the stock and tried to use the stock repair. But the naked put still had that same problem with the covered calls, even though you can go further out of the money a little bit, but it wasn't a long-term wealth option. You can just see by the risk-reward ratio. Now, after that, I did delve in. I was doing collars with most of my portfolio at that time, about 2 years in or so. And then I started to trade, credit spreads. Gentleman that we worked with, Mike Phillips, who was running Power Options Applied for a while, was doing really well with iron condors and credit spreads. So I got into credit spreads, and I did extremely well fairly well for 4 months or so, and then it ended up losing. And the reason why it lost is not because I was over trading, and it wasn't because I was trading speculative positions. It's because this is what I do during the day. I'm writing articles, handling coaching sessions, phone calls, webinars, helping Kurt with what he needs to implement his education at radioactive trading. And a portfolio that's mostly made of credit and debit spreads and iron condors needs a lot more attention than I could give it. I would almost need to spend 2 to 3 hours a day looking at the positions, maybe resetting stop orders, readjusting trigger points and exits. So they can be lucrative strategies, just like anything can be lucrative strategies, but they require a lot more time than I have available to do during the day. Even though I'm on my screen all day, I'm usually helping other customers. Shortly after that, Jim, I went into calendar spreads, calendar calls, and calendar puts. And for about 8 to 10 months, diagonal calendar spreads and calendar puts were the most successful monetarily and percentage-wise option strategy that I have ever traded. 4 months after that, calendar calls and calendar puts, diagonal spreads, resulted in the largest losses, both monetarily and percentage-wise, that I had ever taken. And I didn't do too much as far as that went. I mean, I did edit my ideas, I did adjust my ideas, but the market did not turn from extremely bullish to extremely bearish or extremely volatile to this. It's just different sectors were swapping back and forth, and what had worked 6 months ago did not work anymore, and the leverage is what got me. Okay, so I still like calendar spreads. I still try to use them from time to time, but after taking those losses, I'm very conservative. I only trade them with about 5 to 10% of my total portfolio value at this time. So many of you have heard me say this before. Long story short, I spent 5 minutes on this. I said I wasn't going to spend that much time, but for the past 5 or 6 years, my portfolio personally has consisted of about 50 to 60% of my allocated portfolio has been into the radioactive trades, the married put positions. About 20% or so is in the standard collar positions that I'm going to talk about right now because Siva asked me, can you go over a long collar? And roughly then about 15% of the portfolio I allocate to options trading, I should say the capital I allocate to options trading, I still play around. I'd say 10 to 15%. I still play around with bull put credits and bear call credit spreads, but only on broad-based indexes and ETFs. I don't trade the credit spreads on standard stocks anymore because they're too volatile. And then another 10 to 15% of that portfolio, I go to different strategies to try them, but most of the time in the past 10 months or so, 8 months, I've been focusing back again on diagonal spreads because I like them. They're fun. I think the thing I like the most about a diagonal spread, a calendar call spread or a calendar put spread, is you don't really know what you're going to make. And I know that sounds silly, but there's no real defined profit because in a calendar call and a calendar put, there's also really no defined risk. It is 100% risk, but you never really hit that. But with a calendar call and the calendar put, the equations that you need to calculate what your max return would be in the first 7 to 12 to 15 days wherever you sell your short option, and you're buying an option that's 5 or 6 months out in time, well, it's based on the Black-Scholes pricing model. There's other manipulations you can use on your calendar spread as volatility shifts in the near term and in the far term to maybe get more profit or maybe hedge and not realize more of the loss that you expected to make based on those theoretical calculations. And so most people like the aspect of the collar, the married put, because it's etched in stone directly what you can make and what you can't lose, for example. There's something about the calendar spreads, the dynamic of it that I don't know, my brain enjoys. Maybe it's torture. I don't know, but I really like them, and I'm always trying to play around with new techniques to make them work consistently. They're just not always there. All right, so Siva asks, can you go over a long collar? Okay, well, a long collar is really any combination of owning stock, owning stock, selling a call, and buying a put. Now, when I say that the 20% of my portfolio that's in standard collars, what I mean by a standard collar is something that's similar to a risk-reward profile of a bull call debit spread or a bull put credit spread. But what I like to do with my collars here is I'm going to look for a stock that matches my criteria, and I'm going to sell 15, 20 to 30 day out at the money or slightly out of the money call and buy a deeper out of the money put. In general, I'll leave my expiration time frame here for the options at 10 to 55 days, but I'm going to change my max risk. I'm not going to risk more than 5% of any long collar, and I'm going to put my max return at 2.5%. at the same time, I don't want the call to be too far out of the money. I only want it to be as much as 1 strike out of the money, or maybe 3 or 4%. So I'm going to put my call out of the money 0 to 3%, and then the max risk and the max return, the put out of the money, is going to be dictated by that combination as well. Call bid does not have to be $1. It could be 50 cents for me. But the net premium, I should say, the difference between the call I'm selling and the put I'm buying, I probably want that to be at least 50 cents as well. All right, so I'm just going to do that real quick. Let's see what some of the results we get. I'd like to be closer there. Here's a good, now, actually it's not too bad. It's not too bad at all. I don't know if I like this stock necessarily, but the third one in Alibaba has the risk-reward ratio I kind of look for. And these two ones on Apple look good too, but I think maybe I'd go with the 97 that far out. And this one's pretty far out in time too. Yeah, so let's take a look at the Alibaba, how I would set up a standard caller. And I'm not saying I would do this, but stock's trading at 67.28. We could buy 100 shares of stock at 67.28. And then I could go ahead and sell the April. This one has the April. I'd probably look at combinations shorter term, of course. I only want to really be about 15 to 30 days. In fact, let's go back. I did mention that first, so let's keep myself honest. I'll go 15 to 35 days for the call and the put, so we don't go out to April there, and we're seeing shorter term positions that still have the risk reward we want. Of course, Apple's still going to be there. And, okay, the Wynn Resorts one looks pretty good. Let's go ahead and do that. All right, so here we're going out to March. The stock's at 77.18. I'm selling the at the money 77.5 call for 450, and at the same time I'd buy a March 72.50 put for 285. Why would I give up more than half of the premium I'm receiving for the call to buy the put? Because it still gives me the opportunity that the stock moves up slightly over the next 40 days. I'm still making that, or 30 days, I'm still making the 2.6% return, which is within my range. But if I'm wrong, and there's another collapse like we've seen from January 4th on, I'm only risking 4%. Now, this is subtly different than a married put, because when you open a married put, you don't sell the call right away. You leave the upside open, so if the stock moves up, you can realize more potential upside, and you can maybe sell a call later at a better premium. The advantage of this is you have a dialed-in risk just like the married put, and you're receiving a credit up front and a premium up front. You're generating income just like you would with a covered call, but you've got a capped risk and a capped gain just like you do with a covered call. The problem is it's just like the credit spreads we saw, but it's controlled, meaning that the 4-to-1 risk-reward ratio and 5-to-1 risk-reward ratios we saw and the 10-to-1 we saw with the bull put credit spreads, we don't see that here, but we still typically take on a larger risk than the potential return. All right, so this is less than a 2-to-1 risk-reward ratio. This is about pretty close to the average risk-reward ratio I set up on my standard collar, Siva, but that does dictate that I'm probably going to need to be right on my trades at least about 65% of the time. Meaning 65% of the time I'm going to need to make this 2.6% to pick right in the direction of the stock. And if I take a loss, I want to make sure I don't take the max loss, but if I do, I can only be wrong about 35% of the time to make this profitable long term. Thankfully, I've been lucky enough to have that happen over the last 9 years or so, 9-10 years. Okay, but in general, that's what you're looking at. Now, remember what we talked about with covered calls. If Wynn Resorts, I mean, this premium does look pretty volatile here. It does look pretty high. If Wynn Resorts gaps down and falls 20% of its value, well, let's say a little bit more than that, but yeah, let's say, oh yeah, no, 20% is fine. Let's say it falls down about $14 per share and is trading now down to $63. I'm only losing 4% or $303 on my collar. If I was in a covered call and we accepted the 450, but the stock dropped down $14 to 63, that's minus 14, well, we'd still be at a $9.50 loss on the stock, which is more than 10%, because they would get, the stop order would get violated, okay? So that's what I look for in a standard collar. But again, a collar is a definition of any combination of long stock, short a call, and long a put. So if I did this further out, if I maybe bought a married put position by buying Wynn Resorts at 77.18 and bought the June, let's say, 80 put, okay, This would be a typical married put position where my put's further out in time, higher risk than I would normally take, but I have an unlimited upside that's not capped in case the stock moves up. But now, later on down the road, the stock, let's say, moves up closer to $80. It's close now. But let's say later on down the road, maybe I sell the March 80 put, 80 call, and we get this $2 here. And call it 220. This is a collar as well, but it's more related to a profit and loss chart of a diagonal calendar spread, where the protection, the put here is further out in time, and the premium that we generated that we sold is shorter in time. Okay, so this looks more like the calendar spreads that we have, a calendar spread risk-reward profile as opposed to that standard collar. But this is still a collar. It's just a calendar collar because it's different expiration dates. All right. Excuse me, going back here, we were talking about bull puts a little while ago. I apologize, I saw this question come in later. When looking at the bull put credit spreads, Jim said, do you recommend the stop at 1% above the short strike? Yep, that's what I use in my bull puts and my bear calls. It's talked about in the webinar there as well as one of the exit points. So if in a bull put where maybe I sold a 50 put and bought a 45, the stock might have been at 54 or so when I did this. If the stock starts to drop down and it drops to within 1% of my short put, it drops down to $50.50, that's when I'm going to start analyzing, rolling the position, adjusting the position, converting this bullish position to a bearish position as the stock is falling, go up, the different management techniques we talked about there as well. So that's what I'm going to look to do. Use the 1 to 1.5% rule. If the stock reaches within 1 or 1.5% of my short put strike price in a bull put spread, or 1 or 1.5% in my bear call strike price in a bear call, that's going to be my trigger point for adjustment. Okay? All right. Okay, Robert says, I have a general knowledge of options that have traded with moderate success for about 2 years. Just signed up for the 14-day free trial. What is the best steps to take over the next 2 weeks to assure that I can make a confident decision to sign up as a long-term client? Another fantastic question. This might help Paul out as well. Let me just go back up here, okay? Calvin, real quick, Calvin said, I made a lot of money trading condors, then I lost a lot of money trading condors in 2008. Yeah, any bullish or leveraged strategy there as well would allow to do that. Okay. Okay, and Siva, I'll take the diagonal in just a moment here. Let me just get back to this question here. We still have a few questions coming in. So let me go back. The question that just came in there was regarding what are the steps you need to take. Well, they're outlined for you. If you just started your 14-day free trial, the steps here that you want to start off with are outlined for you to help you get a better view. Take advantage of the 4 steps when you first log in. If you haven't done so yet, you can take a look at the free quick start guide, or you can view that, I believe, right in the Learning Center. There are some flash tutorials that will help you get more familiar with the tools on the site. These are interactive walkthroughs on setting up the search, where to click to get the chain, and more. We do host free webinars during the week, but what you may want to do is go into the free webinar section, as we mentioned earlier. Under the tools category, you'll see things such as setting up the search tool, basic overview of what is PowerOptions, your one-stop shop for options investing. That's usually where you might want to start. How do you find new options trades, researching and analyzing a position, using the portfolio tools, searching for covered calls, bull put credit spreads, just some general introduction on the search tools and the functionality. The second step is, if you know your strategies already, if your strategy is listed here, if you're looking at long options, naked puts, vertical spreads, or so forth, go into the options strategies section as well. There's some useful information in the options concepts. If you have a stock that's fallen in price, there's a webinar on what steps we use to manage our broken positions. Exercise versus assignment, weekly options, implied volatility, Greeks, and so forth. Okay, and then a lot of random topics thrown into our requested topics section, which is the Friday webinars that are archived for you as well. So the first steps I would go through, and of course we don't have a webinar every day, so you might want to, if you haven't yet, check out the quick start guide. Go through some of the flash tutorials, but you can go through those webinars, those archived webinars at any time. Jot down your questions. Start going through the site. As soon as you have any questions, you can send us an email to support@powerop.com at any time. And you can schedule one of the free coaching sessions, and that's essentially a 45 to 50-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Let's see here. Okay, so that's that. Jim asked a question. I'm going to go into the diagonal, an example of a diagonal in a little bit for SIVA again, since we were on that topic. But going back to our collar discussion, very quickly here, let's go back to Wynn Resorts. Jim asks, do you try to get more credit for the call than the cost of the put? Well, yes, when I'm doing a standard collar. That's why I put in that minimum premium, what's called the net premium, the difference between the two, as a positive 50 cents. If I'm doing this standard collar setup, I'm always doing it a credit. I know some people who do debit collars, where a debit collar might consist of, I'm going to buy the stock at 77.18. And for a standard collar, let's keep it at March to keep things simple, I may sell the 75 call. Now this one isn't going to do it real well. That's still a high enough premium. That's all right. See if I reverse it. If I sell a 75 call and buy a 77.5 put, that's still a collar, but now I'm long stock in a bearish position. Okay, so I'll show you what I mean. If we sell this call and buy the 80 put, what we've essentially done is created a synthetic bear call credit spread, but we bought the stock to do it. Well, if I thought the stock was going to go down, I'm probably going to use a different bearish approach and not this bearish collar. I'm not going to own stock to play a bearish position. But this is an interesting management technique that might be available if you have a covered call that's going against you. You might be able to buy an in-the-money put, and if the stock continues to fall, you could actually make money on the downside where you'd be losing originally on the covered call position. It's an interesting technique. However, going back to where we were, yes, Jim, when I sell the call and buy the put for a standard collar, I want positive premium. I want a credit. All right, so we looked at the 77.50 and, excuse me, folks, the 72.50 there. Maybe we were at the 75, but that's okay. No, this is it. Okay, so that's a positive premium. I'm taking in 450, but only spending 285. If I'm in the long-term married put and I sell a call against it, which is income method number 1 in the radioactive trading techniques, no, I'm not trying to get as much credit. That's a different approach. It's a different longer-term strategy. So for the standard collar, which to me is more of a 1 month out or 15-day out, similar to a covered call or naked put trade that I'm hoping to get assigned and earn the maximum return or have it expire worthless, then there we are. That's what I'm doing. Okay? Scott says, how do you manage if the stock turns down? Would you sell the stock and change the downside? It depends on my sentiment. The ways to manage a collar are similar to a married put. If the stock falls, I can exit it and take the small loss. If at expiration on this collar, Scott, the stock's between the strike prices, I still probably have a positive premium or close to it. Let's say it's right at my break even. Well, the stock fell down to 75.53 and I have no gain or no loss. Maybe now I can sell a 75 call for April and buy the 70 put and still have a collar with maybe a 2% gain to the upside and only risking 4%. Okay, that might still be a reasonable, what I call rebracketing the collar. Right, that's a potential. If the stock fell below both strike prices and I did nothing and I got to expiration, well then I'd probably just close it and take the loss. I could rebracket as well and move everything down. That's not what I'm going to do. Now, let's say I just opened this Wynn Resorts position this morning or sometime today, and the stock fell. Let's say it falls on Monday and is trading right down at about $73 per share. What am I going to do? Well, I may analyze buying to close the short call and selling to open the 75. Okay, I'm probably going to lower my max return, but I still might be profitable and generate a little bit more positive premium here to the downside now that the stock's at 73. I still have the floor in place, so I'm comfortable with that. If it continues to fall more, maybe can I just close the stock and let the put ride? No, because I have the short call. So that would leave a naked call open, which might adjust my entire margin requirement for this position in my risk-reward profile. Can't do that. So yeah, there's different ways to management. There is a webinars as well. They're older webinars that we put together, but in that webinar section, there's webinars on the protective option strategy, which discuss, of course, our approach on the married put and the collar spread, and of course, management techniques as well. Yeah, and we discussed that earlier, Jim. Jim says far out of the money credit spreads have a high probability of profit, although small. That's right. So with the credit spreads, it's a balance. And to tell you the truth, I would have been better off, we talked about that 10-to-1 risk-reward ratio. Let's go back into the search here for bull put credit spreads. I'm going to increase my probability to 80%. Okay. Now, I'm looking for deep out of the money put positions, bull put credit spreads that have a high probability of expiring worthless. But that means on, a 250 spread, we're making 40 cents. Here's a dollar spread, we're making 14 cents. So we're at double-digit 10, 15% potential returns. I'm sorry, 19, 16% returns. But you're making 40 cents, 14 cents, and so forth. But we're going deeper out of the money. So where's the trade-off? Well, the trade-off is I could make more money on a bull put spread. The stock's at 77.18. I could sell the 75 and buy, let's say, the 72.5. But if we're in a bullish direction, and this is a season like it was back from January to where we are today, and all of my bull puts I opened were one strike out of the money with only a 60% probability or 30% return, I would have had the full loss on all of those positions as the market fell. It's as simple as that. So is it better to take smaller credit, be further out of the money, and even in downward markets here in this bull put credit spread where you may have to close this for a loss, but it may be a small loss, I may have to close this for 50 cents or 60 cents, or is it better to get the higher premium up front, maybe a dollar, $1.20, going with a 75, 72.5, but getting closed out for the 250 loss 50% of the time? In general, we think that this would be the better approach. These results that we've set here are based on some back testing that's Ernie's done, the default criteria here, especially the weekly bull puts. Looking for the probability of what worked the best over the course of a couple years of back testing to find the position. Historically tested parameter suggestions for improved returns, and you see that the minimum probability we're looking for is 70%. With also being at least 3% on the money, and that's for a weekly option. Okay, that's for 14, 12 days out in time. So the idea here is, why aren't we going with the closer to the at the money position, even with the weeklies that might be offering a higher premium? It's because historically testing, those do not work out. You take more losses than you make gains. Okay. All right, let's take a look here at some of the other questions that we have. All right. Okay, yeah, we talked about a diagonal spread. The diagonal spread now is similar to what we saw with that. What I'm going to do here, well, okay, let me go back. I thought I had a profit and loss chart still open, but I didn't. So let's go ahead and add calendar spreads. And you can essentially say, anytime you have a question, Siva, of what kind of X do you do, the first place you want to go is just go into the search for that strategy. All right, so I'm going to go into calendar call, and I'm going to go to search. This initial value set, I set up this criteria here. Ernie changed it, I can tell. It's quite all right. But what I would do here, change the initial values. Instead of using all leaps, I'm going to go all months. And I'm going to go 90 to 250 days out in time, maybe even 300. And I'm going to go all months here too. I'm going to go 15 days to 35 for my short option. So you want the short option again to be within that 15 to 35 day time frame. You can go 7 days, but I haven't had much luck with that. And you want your put to be at least 3 to several months out in time. The net debit, that's up to you. I'm probably going to set this at 10. That's good. Max return is good. Now, my short call out of the money, I don't want to go too far out of the money, but I don't necessarily want to be right at the money. So again, we're going to go 0 to 4%. And I probably don't want my call that I'm buying to be too deep in the money. So I'm going to limit this to 15%. But everything else here is what I want. I want this kind of delta ratio. This is where it gets more advanced. Strategies like this that have different time sets, you've got to set the delta ratio. And this debit to strike difference ratio, I'll explain that in a second as well. But then, for the calendar call, you're going to have to look for the same stock criteria you'd look for of opening a covered call, a naked put, a bull put credit spread. You're looking for stocks that you feel are neutral to bullish in price. So that was probably too, well, try it. Probably do something better, or different, excuse me. I'd do something different here. But that's all right. Let's take a look at Dollar Tree. Currently at $79.44. We have an opportunity of a March 82.50 call for $2 and buy the May 70 for $11.60. Now we're going to pay a debit of $9.60, but we see a potential return, max return at March expiration of 38.2%, and we are collecting 17% of what we invested in the position. What does that mean? Let's take a look. Here, I'm going to buy the May 70 call for about $11.60, and I'm going to sell the March 82.50 call for $2. Now, this return of $367 or 38.2% is theoretical. It's not etched in stone. What the system is doing is calculating two things. We know that if the stock's at 82.50 at expiration, our March call would be worth nothing. But we have to use the theoretical Black-Scholes pricing model to estimate what the value of the May 70 call would be if the stock was trading at 82.50 at March expiration. So this is a theoretical return. It's not etched in stone, okay? And it's based on using this volatility here. So it shows us that we might have a profit of 410, which is above the 38.2%, but I don't know if that's entirely accurate. Let me explain why. This volatility number that's being used for the theoretical calculations, what the value of our long put would be, is based on the average implied volatility of the near-term options, what's called the SIV. My May series may have a slightly different volatility and be reacting differently. So what I want to do is I'm going to click my Edit More Information button here. I'm going to look at the option research, and I see that my implied volatility here is 3516 for the actual May option. That's important because now I want to see what happens to the theoretical worth of my May option if I change this 3516 if the stock was trading at 82.50. And that's a little bit better. Okay, now we're dead on. We're dead on that max theoretical return, but it's still theoretical. Okay, if the volatility drops for whatever reason as we get closer to March expiration, if the volatility on our May call drops, this would be lower. If it increases, we could actually get a higher return. That's a possibility with volatility flux, okay? So that's a diagonal spread, and what I'm typically looking for is, your debit is your debit. Remember one thing here, this is also a leverage spread. You have more time, or what we call right cycles here, because you're out several months with the long option. This is really, by the way, a bull call debit spread where the call option that you're buying is further out in time to give you more times to write against it or more available time to adjust the position if it goes against you, okay? So that's what we're kind of looking at here with the calendar spread. Now, is this combination better than maybe selling the 80 strike call right now, which would bring in a better premium, and buying maybe only the 72.50 or the 75 for a lower price? Well, we'd have to check that out. So let's go to March and May again. We're going to go right at the money with the 80 call, and we're going to go out to May, 91 days, and we're going to buy the 75 call about 790. Okay, so let's take a look at those. Now this spread offers a much higher return, but notice there's something different about this. The max return on a calendar spread is achieved if and only if your stock is trading right at the short call strike price. That's the maximum return. As it starts to go higher, in this particular one, you're giving more money back. You still have a profit, but it's declining. Why? Because at March expiration, something, lack of a better term, magical happens. Even if the stock's trading at $90 per share, my 75 May call may not have a delta of 1. It might be at 0.85, 0.86, 0.90, but it's not going to be at 1. But as we hit March expiration, our 80 call will automatically go to a delta of 1. It's just going to have intrinsic value. So if the stock's trading at 90, my 80 call is going to cost $10 to buy back, and my 75 call probably not going to, it's going to be worth about 15 or so, but then time value added in would be about 1535, 1536. So liquidating the position at that time is only going to give me 535 back, let's say, but remember, it'd probably be higher than that, but if it gives me 535 back, I paid 480 in. So that's really only a profit of 55 cents. That's nowhere near the max. And the max return is saying if the stock's trading right at the short call strike price at expiration. So a little bit more complex. You've got two moving parts that you need to pay attention to that are subjected to volatility, volatility shifts in delta, and that's what you got to take a look at. Okay, so that's sort of the diagonal calendar spread, and it works the same way with the puts. I buy a slightly in the money put that's 3, 4, 5 months out in time, and sell an at or slightly out of the money call against it to receive the premium there. And if the stock falls, you'll have the profit, and if it continues to fall, you still have a gain, but your risk now is to the upside on the calendar put spread. All right, question from Scott. Okay, do you have a suggestion for this? I put a married put on CVRR. Spread killed me. The stock was bought at around 19. The stock's fallen to 10. Spread was $1.50. I like the stock for the future. I'm thinking of averaging down and picking up puts depending on the risk. What do you mean by the spread was 150? Did you do a bull put, Scott, or a married put? And if you did a married put, and you have the put still further out in time, you think the stock's going to recover, you may look to use income method number 9. Oh, yeah, okay, the bid and ask spread's a bit wide, okay. Yeah, I mean, if you think it's going to recover, you could use income method number 9, knowing that that's going to increase your risk. Okay, your monetary and percentage risk will increase, but if it moves back up, you'll be able to make that back. If you leave the position as it is, if you don't think it's going to fall back anymore, then you won't be able to do that as well. You'd probably want to use income method number 12. It's going to continue to fall. In some cases, I've heard Ernie talk to customers and say, look, depending on where your risk is now, naturally you've got a few choices. Liquidate the position, take the loss, try to find a better position to make your money back. You think the stock's going to recover? Is it better to liquidate now and then buy into a new married put on CVRR using the current prices? It's going to be about the same if you roll down with income method number 9. Honestly, and then you may try to do an income method number 5 right after the bat to repair it. If you think it's going to continue to fall, you're concerned about it continuing to fall, you might use income method number 12. Scott, that's probably a better question to ask to Kurt. The direct questions about management techniques on some of the married puts, not that I won't answer those, but if you want to see some more insight on if you could use maybe an 11 or 12 or if he's working on anything new, you can always send your questions as a blueprint owner to support@radioactivetrading.com, address them to Kurt, and he'll take a look at the numbers. But yeah, if I'm in a stock, I still have time to go on the put, it's fallen, but I think it's going to recover, I'll evaluate income method number 9. If I was just wrong on the position and the stocks dropped 50, 60% or so, 40, 50, 60% from where I got in, I'm at the full loss right now and I think it might recover, but I'm still concerned, I may just liquidate and take the loss and then go forward with a different position. I have a position like that right now, to be honest with you. It's on Seagate. Stock's been all over the place. I think I got in at 54 and bought the 60 put. It dropped down to 48. I rolled down to the 55 put. Over a 2-week period, it precipitously fell down to 37, then to 33, then gradually down to 32, 30, 28, and then when I thought it was going to continue to fall, it was going to have poor earnings, used income method number 12, and it went the other way. So it went back up to 33, 34. I was going to roll down yesterday with the put, but then the stock fell another 2 points today and is back at 31. I've been trying to catch income method number 5s in between these moves of 31 to 34 and 35, but the risk reward profiles just look terrible. So I'm going to try 1 or 2 moves before expiration just to get the risk down a little bit more, and then I'm just going to close the position. I'd rather be in a better position where I have more opportunities than to keep following it this way. Jim asks, have the sample searches been back tested? Oops, sorry about that. Just knocked over my sheet there. So you all probably heard that in the background. Many of them have. Some of the covered call searches, I'm sorry, I clicked the wrong button there, Jim. The covered call searches such as the 7-Eleven, broker recommended, I believe the ETFs one I did some work on. The 5-star one, there's one here that that Ernie and I were talking about getting rid of. I think the 5-star one we're going to get rid of because it's very similar to the broker and advisor recommended, which was tested more than the 5-star one. And that as well. The naked put sample searches, I believe, were. In the case of married puts, you don't want to use the sample searches. You want to stick with the search and use the radioactive trading default criteria. The bull puts, no, we did. Most of these have been back tested a little bit, not as extensively as some of the main searches that we saw on the main search screen, for example, but the bull put main searches have been done. They can always use improvement depending on different market conditions, but they're still open, okay? And what I mean by that is that we're not trying. We've back tested them to tweak them a little bit, and I don't want to say to protect ourselves, but to give our investors, to give our subscribers a little bit of benefit of why are we doing this. You notice that most of the weeklies, I get this question all the time. If you go into a weekly covered call search, naked put search, or bull put credit spread, the weekly search is set automatically for a default of 8 to 17 days. So everyone who comes in says, well, where's the 7-day options? Well, based on our back testing, we found that a better return is going 14 days out in time in pretty much all the strategies we're generating premium, because going 7 days out in time, you're not getting enough premium, and when you suffer the losses, they affect your account exponentially. So if I sell a 7-day out trade and the stock moves down $4, let's say a covered call, and I lose $3.50 on the position because I only generated 50 cents, I did the same position 14 days out but generated 90 cents. And then I was able to roll down another 14 days out and pay for it. It works out better over time that way, actually using the 14-day out because of the slightly better premium. Okay, and every backtest result that Ernie ran for bull puts, cash secured naked puts, and covered calls when looking at weekly options, going 14 days out, 10 to 14 days out, was always outperforming the same criteria that were 4 to 7 days out. Just an interesting little factoid. All right. Okay, well, ladies and gentlemen, it's at 5:40 p.m. Eastern Time. I think I managed to get through all of the questions that we have so far. If you do have a last-minute question, go ahead and send that in to us as well. Sorry, folks. I'm just going to move on here. I just want to remind everyone as well, we had that question coming earlier about where to get started with a 14-day free trial. Remember, after your 14-day free trial, there is an end-of-day service, so you only get data updates at the end of the day, and that's $40 per month. The 20-minute delayed service is $60 per month, and we do offer a real-time service that's $100 per month. And at any given time, of course, you can access the historical tools. It's $40 more. So the 20-minute delayed data plus the historical service is $100 per month, and the real-time plus historical is $140 per month. So you get access to the backtesting tools as well. Whoa! Sorry, folks, that wasn't supposed to happen there. I just clicked on the link there for the webinars page again. Just wanted to, of course, oh, wow. Okay, sorry about that. There we go. Okay, sorry, folks. So I just wanted to remind everyone, if you do have any other questions that you think of later on, just please feel free to go ahead and send us an email to support@powerop.com. Of course, you can also reach us market hours, during market hours, 877-992-7971, or of course, you can reach us anytime if you're international at 302-992-7971 as well. Okay, let's see here. All right, there we go. Let's see. Okay, Steve says, last minute question. Should we run the weekly search on the weekend or Monday morning? I tend to go Monday morning. Okay, I do research on some stocks that I might find for married put candidates or calendar spreads sometimes over the weekend. But if I'm looking for a new trade in something such as a weekly covered call or bull put or bear call, I may know some of the stocks and I may create a stock list to look for that. But in general, I'm looking at Monday after the first or second data run. And the reason why is because I might have seen a covered call where I could buy Win Resorts today at 77.15 and sell the 77.50 call for March for $2.30, or a week out for $1.50, okay, for next week for $1.50. Come Monday morning at the open, the stock is now at, let's say, 74.35. The 77.5 makes no sense, and now I got to see if I like the 75, you know. So that's why I usually wait till Monday morning to open a weekly trade, because I need to see where the stock is. But if I'm going long term with a married put or a calendar spread or something along those lines, I may have done my stock research, and then I know in my mind what debit or maximum risk I want to take on the married put. So even if the market changes on Monday, the stock and the puts move, I'm going to put in an order of what I want for the max debit to be between the stock and the put, or between my long call and my short call. And it's easier to do that because that long option moves in step with the stock, but not one-to-one. So I can still get the debit I want, the risk-reward profile I want, whereas if I'm doing a weekly covered call or weekly bull put, the strikes probably changed if the stock moved up $1 or $2 at the open or fell $1 or $2 at the open as well. And JJ, he had a question earlier, but JJ asked, do you have an order button which I can link with Interactive or TD Ameritrade? Unfortunately, right now, we only have the broker link set up to Options Express. It's not available for Interactive Brokers or Thinkorswim. Okay, so right now it's just available for Options Express. My apologies at this time. All right, well, I think that about solves it. Gets through everything. Ladies and gentlemen, thank you for joining me. Have a fantastic weekend. And we'll see you all soon next week at one of the live presentations. Remember, Kurt's going to have webinars on Tuesdays and Thursday at 12 noon Eastern. We'll probably have a webinar Wednesday at 12 noon Eastern time, and again at Friday at 4:30 p.m. as well. Take care, everyone. Good night.